I'm going to show you a full 1-minute trading strategy with exercises that you can use as a beginner and even as intermediate trader. So here you can see my screen, and important here to understand is on how to start for you as a beginner. This is TradingView. TradingView is absolutely for free. Just sign in using your Google account or any account there, and then make sure here that you select your time zone. That means in my case, I'm from Germany, but if you're from New York, for example, Toronto, or Chicago, Denver, Phoenix, just select anything you like here, wherever you're at. And in this case, on Central Time, from between 9 a.m. to 4 p.m., you can select anywhere 1 or 2 hours freely. Make sure you draw in a square. So in this case, you would not be able to see the future. So in this case, we're starting here. I'm going to show you how the exercise looks like. From here, 4:21, for example, we go to 5:21, but please make sure this is really between 9 a.m. and like 4 p.m. Central Time at least. So 4:21 to like 5:21. So you can see we made here a square, a box within 1 hour. And then at the top left side, you see here the 1-minute chart. Make sure you selected this one, by the way. And the market is the ES1 exclamation mark. Why is it the S&P 500 futures? Because when it comes to money exchange in the S&P 500 futures, we're talking about 300 to 400 billion dollars what is going in and out, and a euro US dollar has around 37 in the future and 100 billion dollars every day combined going in and out. If you would trade gold, if you would trade silver, like we're talking about maybe 3 billion, 4 billion a day going in and out, and you will see less movement. So the S&P 500 and the euro US dollar, they are going for hours just in one direction. It will be way more easier for you to see in what direction the market is going at, and also have better trading signals. Because if you sit down for 1 to 2 hours, the money making activity is how many times can I see that I can put in $100 in and get $500 out in average. And if you have 30 to 50 opportunities within 5 weeks in average, by just trading for 1 or 2 hours, you will be able to see which of these 30 to 50 opportunities are the 10 good trades, for example, or even 20 good trades, because with quantity comes quality. So first of all, here we have here a tool that is the path tool. You find this one on the left side here, as you can see your path. We use this one to draw in the past 1 hour. Just like here, like this. And when you do this and you move this forward, now you have sort of a trading plan based on anticipation. You would like to make sure to understand that the market likes to go at bigger structure lows and bigger structure highs. And if it cannot go there, there's the volume weighted average price, make that in. The market usually likes to go to the volume weighted average price. So as you can see here, for example, market goes towards the high, cannot go above. Now it goes to the 1-day VWAP. And then because it cannot go to the 1-day VWAP properly, or doesn't hold here itself for hours, it continues to go down, attacking this low here right now. So this is a very, very good trading plan, for example, trading that direction. So now we determine, by the way, our direction. Now we determine like what makes actually sense for us to look at. And the next thing is now about money management. Can we see that the market is going in that direction and can adjust $100 to get a $500 trading opportunity out? In this case, I love to just have one single setup, and that is a color switch. That means if you have a green and a red candle, you place your stop placement on its color switch, and the take profit is on its low here right now, or a bit below here, just so that the risk reward ratio equals to 5. That means if you would enter a trade right here and you adjust from entry to stop loss, this is the color switch, and you would like to place the stop at its highest wick. If you adjust here $100 that you could lose, then when you're selling, this would be each time the same length, $100 and making money. So it's like $500 for a winning trade until here, but $100 for a losing trade if the market goes up here. And that's just something what is very important to understand on how to enter the trade with that money management. I'm going to show you here an example from yesterday, for example. Let's go here. So here, for example, you saw that the market was just going roughly up for the past 1 or 2 hours. And then you start your trading, you put this a bit forward, and then you'll see that the market is around the same length again, starting here or let's just say if you would have started your trading here around like 10 a.m. and you were like looking at the past hour, like 9 a.m. to 10 a.m., you were just like drawing this one in like that. Check this out. The market did around the same move in the same direction. Now here's one important thing, and I will show you how to treat consolidation phases. This is something what is very, very interesting, and also an indicator that is called the anchored VWAP. So when you see that the market is going up, you want to make sure where does it actually likes to go at. So in this case, we have here this high that was here, and the next high is up here. We have a small hidden high that is here in between. Check this out, because here you can see the structure goes up and then it goes down, right? And the important thing here is now that you will see how the market is reacting on these targets. Check this out. You'll see now the market is touching this target here, comes back. And then once you see here that it does a higher low, this is something what is very interesting. You can take a square and you'll find very often similar retracements in length. Like from here, from top to bottom, check this out, that the market was going up. From top to bottom, from here to here you can see the market is reacting. Now check this out here. And from here to here, the same length again, and then the market was going up. And now for here, it's very interesting. Why? Because look at this. Here you can see that the market does the same length from top to bottom and then starts to go up. And that's just something what is very important, that you see similar retracements going in that direction, and that you understand what are higher lows and what are the lower highs to identify a trend. So a low is a red and a green candle. That means, for example, here you have a red and a green candle in combination. I'm going through with you some candles here because it looks maybe a bit hard to read for you in the beginning, but after you're watching this one, it should really help you. So you have here red, green, and then you have green and red. So that means the red candle shows us that the market was going down. The green candle that the market was going up. It looks like this, like a V. This is a low. The low shows us within a specific time period, the lowest point. And green and red, the opposite side, the highest point within a specific time. So when going now here inside, starting here, and important is if you just see like the market is just in one area, like here, it doesn't make that much sense. You would like to see that the market pushes up, and then now you're reading higher lows. That means red, green here, red, green here, red, green here, red, green here, red, green here. You can see how these candles are more like inside with each other. So to treat this one, it's just like, if you see like this, don't try to read the smaller higher lows, just like try to read this one if possible. If that's too hard, just try to ignore them and take the next one, like this one. Did you see, you need to see really that the market is ranging back healthy. And then once you see the color switch, this is where it makes sense. So here we have a small uptrend. We see that the market is here multiple times doing here higher lows. And here you see it's pretty beautiful. And if a trader would now here enter the trade, it means adjusts here $100, for example, within this color switch, stop placement, take profit as this high. Totally understandable. The main problem is just that if you zoom out, you will see that the market was reaching this target for 3 times already. And the problem is that a support or a resistance is breaking off momentum. That means when trading towards, like for example, when trading from here, adjusting here $100 to make up here $500, that would be a very good trade, or until here, because you could still exit here with $200, $300 for this trading opportunity. But if you are starting to trade here, exactly where the market is going to break down its momentum, the problem is that you get a losing trade is very high. So that means you don't even have enough space to manage. Instead, you would like to rocket the trade up. That means like here you see the similar retracements. I'm going to copy this length here 3 times that you can see that it has exactly the same length. Just copy and paste this, you can see here. And then once we see here that the market does around the same length down, once you see here there's a higher low, that means like from red, green to red, green goes higher. This is higher structure. Some people say higher highs are also good for an uptrend, but if you wanted to write this down, higher lows for an uptrend, lower highs for a downtrend. A red and a green candle is a low, and a green and a red candle is a high. Very important. And then the difference from left to right, like reading hours from left to right, is the higher low, or here's the lower high. You can revert this, by the way, it's a video. I hope this will make your trading better. So here you have literally the the thing that you see here, the color switch, adjusting $100 from entry to stop placement, and then the risk reward ratio of 5, as you see here, is under here. But managing your trade at 3.5 risk reward ratio, something what's very important around this area here. Why? Because you just adjust to $100 and you're $350 in take profit. That means you're just forward $350. You don't want to give up here unnecessary moves, right? You don't want to like let the market retrace for $500 to make another like $700. That doesn't make that much sense. It's very important to adjust $100 and then to shoot the market up towards its resistance or support line, what the market feels attached to, and then to exit there. So here, for example, you see within this trading opportunity here, the risk reward ratio is 3.5 towards this target here, the high of this bigger structure here, what is very important. And then once you see here that the market is it's not doing what it's supposed to do, it's just very important that you are managing your trade well. That means, for example, you're in the trade, you see it's 3.5 up here around like 3.0, and then you are letting the trade push up, and once you see it comes down, once you see 1 time, 2 times, 3 times it doesn't want to proceed, you can just exit the trade without unnecessary needing to have a stop loss. Stop losses occurs very often when trading up here right away, trying to buy here, because you can see how the market is retracing here. And this is the main reason why letting the market retrace is just so important. An additional thing, by the way, for you, I hope this one helps out your trading, is if you see in general that the market is in a consolidation phase, like this here, and you see the market pushes out and is not touching this consolidation phase from here to here, this is also a very good sign, by the way, that the market likes to go initial. Initial by saying that the market here likes to go towards this bigger structure high and doesn't want to come back to this consolidation phase or even to this bigger structure low. Use this for your trading.